Hi everybody, this is Eitan Rotem talking to you. This is the Market Extraordinary special edition about the market past the US midterm elections, and the target of this episode is to prepare you for the coming events that are going to be abnormal and you must be prepared for them. Just before we kick in, it's very important to understand what's the difference between a strategy and a forecast. Someone with an investment or trading strategy doesn't need a forecast. Look, forecast is something very hard, as Mark Twain put it very nicely. Forecast is very hard, especially about the future. Forecast is something actually impossible. Nobody can forecast the future. Many have tried during the entire human history. Just impossible. And the more complex is the world, it is less likely to forecast the future. You can only have a solid strategy to give you very specific on certain instructions, what to do, when not to do, and not to be carried away by illusions and spontaneous feelings that you may have in reaction to whatever the market is doing. When you have a strategy, you are like a sniper. You have to do a lot of waiting, because it's not just waiting for the singular important moment and all the other times are wrong. No, not like that. There are many bad times and wrong times, but are also enough times to do what's necessary to do, what's right to do. But you have to do the waiting. You understand that hitting and waiting are two sides of the coin, but waiting is much more important because hitting is just the end results of good, strategic, focused waiting. The other side of the coin is just someone like a kid who has all the freedom to hit all directions. Doesn't get you nowhere. So whoever needs a forecast necessarily doesn't have a strategy, and this is, my friend, not a good place to be, no matter where, especially not in the stock market. Let's take a look at just a recent forecast. Why the Dow Jones Industrial Average could begin a 70% decline in the next few weeks. Hold your horses, guys. Please pay attention. It's from December 13, 2015. And you will remember what happened from that point onwards. It went up 40%, not down 70%. So this is forecast. You have lots of forecasts and gurus and experts in their own eyes throw stories and opinions in the media. And guys, these are just stories. They're usually backed with something which is handedly picked to support the view, but actually it's just a story. Well, strategy is not biased toward either side or any point of view. First and foremost, these guys that you see here on the roller coaster are there for fun, but roller coaster in the stock market is not fun at all. So you have to strategically decide that you don't want a roller coaster in your life, both financially and mentally. You certainly don't want that. And in order to achieve that, you have to stick with the dominant direction, whichever it is, the long side in the bull market or the short side in a bear market. But you have to stick with it and to step aside in the wrong times. And every year there are 3 or 4 or maybe sometimes 5 months there are bad times and go against the major dominant side. So if you are a long side in a bull market, you have to make sure that you take your profit and step aside during these inter-year cycles. But the most important thing is when the trend reverses, and then you have to abandon altogether the old dominant side and move to the new dominant side, which is the opposite side, of course, unless you want a roller coaster in your life. A strategy is also seeing things by what they are, and sometimes it's not convenient for us to realize and to acknowledge a new reality, which is not exactly what we wished it would be. There's a huge difference between strategy and wishful thinking, and the world is filled with wishful thinkers. Don't be like them. Don't be one of them. When something goes wrong, pay good attention and make the shift. If you don't like it, change it. If you don't like your reality, change it. And the way to do that is by a strategy flexible enough to change when things change. And last, strategy is facts, not stories. I have stories, everybody has stories. I have thousands of stories every week. I'm killing myself not to be driven away by my own stories. Don't be fooled by your own story. Stick to the facts. Sometimes the facts will support whatever you wish to happen. Sometimes facts are defying your assumptions. Stick to the facts. Let me throw you the first fact. It's not going to be so amazing, but it's going to be ugly. This is called the long-term strategy. If you are a VIP client of a portfolio manager, or family office, or these fancy departments on investment banks, so you've been heard that you are advised to have a long-term global portfolio. It's wise to have a big chunk from the US stock market, some chunk from Europe, maybe from China, Japan, South America, maybe Israel too, the high-tech nation. Yes, all well and good, but look at the fact. The fact is October 07, October 18, 11 years, zero. And as a matter of fact, it's not even zero, but it's very likely that during the pressure times, during the crash of 08, 09, or 11 or 15, portfolio manager couldn't hold and had to liquidate some of it. So actually, you have less exposure to stocks in times when stocks are cheaper, and you have more exposure to stocks when they are more expensive. So from 07 to 18, actually more likely that this portfolio did less than zero. And my friends, 11 years are lost time. And 11 years in the stock market, not just a lost decade, it's like eternity, because maybe you don't have a correct idea about the meaning of 5 years of compounding or 7 years of compounding, not mentioning 11 years of compounding, given of course that you are compounding profits, not losses. When I first met my mentor Vince back in 1995, I showed him my results from the years 1987 to 1994, and he told me, "You have wasted 7 years. You have burned 7 years. You could have 10x your money now." Of course, I denied it because I thought the 10x was just a fairy tale, a fantasy. But many years passed, and for many years, I've known that this is actually inevitable because the mathematics work. It worked because if you have a medium-term strategy, and if you just play not something very exceptional, just solid strategy with even a minor edge, a minor competitive edge. And by the way, casinos in Las Vegas, they have about 4 to 5% edge over the 50-50 barrier. That's it, my friend. And they have billions and billions of dollars of revenue and profits because of that little edge. And if you have just a solid edge of 5% above the 50-50 and you adhere to the trend and you stick with the right trend, it's not about the long side versus the short side. It's about the right side versus the wrong side. And let that be compounded by the spiral effect. The spiral effect just says that if you are in the 4th year or the 5th year or the 6th year, that you have layers of previous year's profits to profit on them. That means if you're in the 5th year, you have returns not only on your original portfolio, but also on the profits that you have achieved in the fourth year, and in the third year, and in the second year, and in the first year. So you have layers of profits to compound on them. And you don't have that during the first or the second or maybe the third year. You have just that amount of profits to compound. So the first 2 to 3 years are a long, tedious, slow runway. 19 out of 20 people will just lose and stop and abandon. And that's a shame, because the real prize is just coming after that, in the fourth year and onwards. And if you stick to that, and again, just a solid strategy and solid stick to the major trend, being on the long side in the bull market and being on the short side during a bear market, and compound your money and your position sizing steadily, year in and year out, you will see 5x in 5 years and maybe 10x in 7 years. And that's exactly what Vince told me, and I couldn't believe, and I realized that later in my career. So in order to really strategically compound your money to extraordinary results, you first and foremost must not to fall into the trap of the crash. Actually, the biggest difference in the long run between weak results or even mediocre results and phenomenal results, this difference is which direction our money wears like a shirt during the crash. Is it going to be the red shirt that 19 out of 20 people will wear, or is it going to be the green shirt that you, my friend, are going to choose deliberately to make the crash a green shirt and green profits, and not only not hurting your compounding, not even stopping your compounding or pausing your compounding, you will continue compounding during the crash and making new layers of profits on profits on profits. Because you have to understand that you need a 100% rise or increase in prices to make up for a 50% decline. For instance, if something is worth 100 and goes down to 50, it's a 50% decline. But to come back, to recover from 50 back to 100, just to recover to the original 100, you have to double the money. You can see that as an opportunity, as an actually double opportunity, because you can have all these huge returns in the way up, also in the way down. You can seize the opportunities and capture them and liquidate them in the short side, the way down, and in the long side, the way up. But 99% of the people will miss both years. As a matter of fact, these 2 to 3 years, the crash time and the recovery from the crash, are actually the most profitable years during every decade. I mean, it is going to be more profitable from all the other 7 or 8 years in the decade put together. So this is imperative to you to understand that also which direction our money is going to wear during the recovery year from the crash. So chances are that you're not only not going to profit from both sides, the crash and the recovery, you're going to be hurt by both of them, or at least one of them. And that's a shame, and you can change that today. You can decide. So in order to understand where we're heading, I will have to show you some facts, some hard, cold facts. But before I start pouring the facts, it is crucial to understand one thing: trend change is a process rather than a one-time event. It's a process taking place behind the scenes. It takes months and months and months. When I crashed in 1987, I thought it was a total surprise. It took me by surprise. I didn't know where it came from, but as a matter of fact, it was building up behind the scenes for months and months before that. The crash took place on October 87, but the build-up The build-up had started April 87. It's months before that, and sometimes it takes more than a year to build up the scenario for a crash, because there is only one fundamental truth behind the scenes. It is the insiders. Forget about the quarterly and annual results that companies are publishing. This is ancient history. The only true real-time fundamentals are what insiders are doing with their own money. When you see a heavy carrier like this changes course, you understand that you will see a lot of waves and small waves, mini waves, ripples, and you will get confused. But if you pay attention, close attention to what insiders are doing, you will have the real picture. But it's very, very tedious to watch and to track each and every insider and to see what they're doing. And in reality, it's even impossible, because a lot of that is actually hidden and takes on many, many different forms. So it's counterproductive to even try to directly track them down. But it's very productive to track it indirectly. So may I present the first fundamental evidence. This is, my friend, the number of annual highs on the New York Stock Exchange. If you think about the Trump rally back in November 16, December 16, you can understand that this is a healthy market. Why it's healthy? Because the market is doing new tops, the S&P 500, the Dow Jones, the Nasdaq, the Russell 2000, and the broad market as well is doing a lot of many new highs. We're not talking about monthly highs or quarterly highs. We're talking about 52-week highs. So this is a healthy market that the majority of the broad market is moving forward together. Notice the difference between that picture and January 18 peak. The market, as it's represented by the S&P 500 and other major indices, made all-time new highs. But as you can see, the most of the market did not. I mean, they did, but in fewer numbers. You can see less than 350 new highs as opposed to 450 during the Trump rally in November and December 16. So there is a problem here. This is starting to build up. This is behind the scene, because what everybody's seeing is new highs in the indices and everybody's happy. And then, look at that. A new high in June 18, a new high in August 18, and an all-time new high in September 18. And we have less and less and less new highs. As a matter of fact, we have less than 150 new annual highs in the peak of September versus 350 and 450. It's a declining number. What's the reason behind that? The reason is very, very simple. Smart money is less and less participating in the market, is actually maybe going out behind the scene gradually and quietly and leaving the rest of the herd to support themselves. Nobody else will. To complete that picture, let's look at the number of annual lows on the New York Stock Exchange, and you can see just the opposite. More and more stocks are digging lower and lower and lower, and this is really concerning. Look at the eve of the US elections in October 16, and then August 17, and then the mini crash in February 18, and now the mini crash just recently in October 18. More and more stocks are digging down, and again, we're not talking about monthly lows or quarterly lows, we're talking about annual lows. Stocks that are moving down underneath the lowest point during the last 52 weeks. More and more stocks that are digging down, it means the smart money is actually going out. and there's no one to support these poor stocks. And again, smart money is not supporting the stocks that are peaking, and less smart money is supporting the stocks that are actually starting to crash, or maybe crashing right now. So we have to look at the picture very carefully about the distribution of insiders, which is now at a decade's peak. When I say distribution, I'm talking about major shareholders, hedge funds, executives, everybody on the inner circle of the company are distributing, which means selling their own stocks in the market. When at the same time, buybacks also peak. Isn't that strange? Isn't that strange that distribution is in its peak and at the same time buybacks are also peaking? Here's from Barron's. Companies are buying back stock as executives sell at record clip. What is this buyback worth? Look very carefully about that, because Goldman Sachs is estimating that this year, 18 is going to be a new record, surpassing the previous record. Guess when? That's right, 07, just before the 08 crash. And what's the buyback worth? Look at that. Companies are buying in a massive amount of money, top dollars, when stocks are most expensive, and in 09, after the crash, just spending very small amount of money, relatively of course, when stocks are the cheapest. At the weakest, cheapest point of stocks, the buybacks were the smallest, which means that the buybacks tend to behave like the herd, like the public, not as smart money at all. And as a matter of fact, one may wonder to himself, is it possible that these executives that rescue their money by distributing their own stocks right now are the very same executives that decide on these buybacks? Is it possible that they're sending the money of the other minor shareholders to rescue their own money in the market? Something to ponder upon, isn't it? Right. So let's get back to 07. If we're talking about 07 and we're making some comparisons to 07, so let's look exactly what happened then, and we will be able to figure out better what's heading in front of us right now. So first of all, we had a subprime crisis going on in July and August 07. Before that, in the peak of July, you could see the momentum diverging. That is, we had a higher highs between May, June, and July 07, but lower highs in the momentum, McClellan Summation Index. And then it went down sharply, of course, and start to recover after the mid of August 07, just when Ben Bernanke, at the time the chair of the Federal Reserve, started to lower the interest rates. The market went up and then down and tried to recover again and hit a wall and went back again and then bursted and went on to make a new all-time high October 10th and October 11th, 2007. And again, the momentum diverged and it went down in about the same manner as July and August 07. It really looks quite the same, quite similar, many similarities. And then last week of November 07, it started to recover. But it stopped there. We have to look at two scenarios. There was a recovery here and actually a new all-time high, but the fundamentals went even worse. I mean, new lows were bigger and larger and numerous, and new highs were fewer. And I thought to myself, gosh, the S&P, the Dow Jones, the Nasdaq. All of them are making new all-time highs. By the way, the Russell 2000 did not. The mid-cap did not. It was also a very important sign that there is something diverging here. But the most important thing, there weren't any new highs to identify a healthy market. It was an unhealthy market, and it was flashing red light for us. But it was with a new high, so it was like a giant trap to most of the people. 99% of the people, when they hear about a new all-time high in all the major indices, what they tend to think to themselves, it's all right, it's all rosy, it's all well, it's all good, it's going up, it's going north. But the fundamental didn't support that. And the second high, 2 months later, was a lower high. So at that point, not only the fundamentals were flawed, the market itself could not make a new high. From that point onwards, it's a bear market. And today, this is what we saw. We started to see the momentum diverging during August and then really crashed during September. It was really crashing when actually the market was going the opposite direction. During the majority of the month of September, the S&P 500, the Dow Jones, made new highs. And again, all-time record highs when the momentum went crashing down. It didn't stop until the very first day of November. It's quite similar. It looks the same. It's not the same. It's never 100% the same, but it's somewhat similar. And the similarities are not by chance. It's just a sign for us that the market is going to test and retest, and I'm going to tell you what are the major 3 scenarios that are ahead of us. But first, what is the investment policy of investment banks, portfolio managers, family offices, and the source of that? It's crucial for you guys to know that the policy is always summer. It's always summer in the stock market. They always dress up like it's summer. Always in bikinis. Always. If the market is rising, there is a very good reason why to buy stocks. If the market is collapsing, there is an even better reason why to buy stocks, because stocks are cheaper. It's always summer, and it's wrong, it's flawed, it never worked. I mean, gosh, I've been spending countless hours studying all the collapses and all the recoveries in the history of the stock market. Not only the 200 plus years in the US stock market, but also the 300 years in the European stock markets. Since the 1720 Paris collapse and the 1721 London collapse. Up until today, it's always the same. There is a silver lining between all the collapses and all the recoveries. And it's always the fundamentals. The fundamentals are going against the visible trend. But the investment banks, the major institutions, are continuously smiling. They're always summer to them. And it seems like it will always be summer for their clients until it isn't. So beware of the wisdom that you hear from investment banks and their likes. 2017-18, subprime is back. There are rumors that guys like Citibank and AIG and the likes are again selling the stuff, the ugly stuff, the deadly poison that they have been selling several years before the crash of 08. The subprime and stuff like that. Let's check out the health of Citibank and AIG stocks themselves. And what we can see is that while the S&P 500 made new highs in September in comparison to January, we can see the opposite in Citi, and we can see much worse picture in AIG. So it's just a hint for us that the financial guys, the guys that drove the madness and the crash of '08 and the recovery, are not going very north nowadays. And as a matter of fact, if you look at AIG, it's more than nowadays, actually 2 years now, that they're going more south than north. If you thought that this is just handedly picked by myself, think again. Look at the S&P 500. In the lower panel, you can see higher highs between January and September, and you can see higher lows between February and October. But you can see the reverse is true for the New York Stock Exchange Composite, which is not just 500 stocks like the S&P 500. We're talking about thousands of stocks. You can see the S&P 500 made a new high in September. You can see that the New York Stock Exchange refused or could not make a new high during that time, and as a matter of fact continued and crashed in a manner that it went to a new low relatively to February. This is again a red sign of an unhealthy market. Conclusion, my friends, the recovery attempt is about to happen. It will try several times. It will fail most likely several times, but it will try several times in the near future with three main scenarios. Number one, as in November 16, after the Trump rally, a real recovery means that a real breadth data, new highs, new lows, the fundamentals really support a new high. And this is a change of the picture. The picture that I've shown you is a picture of a change in trend in the making. And it is so difficult, and it has to go through a serious change, a fundamental, for us to see a new high, which is not a fake news, but a real high with real breadth data, real fundamentals. Scenario number two, it's as in September 07, when the recovery took the S&P, the SPY, the Dow Jones to a new record, a new high, actually in October 07, but doing so without a recovery in the fundamentals, in the real breadth data. This is a huge red flag, and at that time we will hit the market on the short side. And the third one is as in December 07, which is worst of the worst, without the fundamentals, but also without a new high, without a recovery, with a lower high and no fundamentals to support the continuation of the bull market. It's also a red flag. So number two and number three are red flags in a process that it is in the making. Scenario number two and number three are more likely than scenario number one. I'm not saying that scenario number one is impossible. It is possible, but it is less likely. What to do for us? Medium-term investors and traders, we just prepare to hit. We never lay down to hit the ball short when the ball is near the floor. It's wrong. It's a patience game. We just patiently wait for the ball to come up to us, then we can hit it and smash it. I wish you all very good luck to everyone, and seeing you in the next episode. Take care. See you soon.